All right, so I'm recording this now, and this part of the presentation on March 16th, 2016 is about comparing solo Ks with IRAs and Roths. All right, so what is a solo K? Well, first of all, an IRA is under Section 408 of the Code, and it's not an ERISA plan that's governed by the Department of Labor and a bunch of other statutes. Whereas a solo K is in fact an ERISA plan under Section 401 and 401K of the Internal Revenue Code. So that's the main distinction, and it has a lot of differences in terms of fiduciary duties that are governed by ERISA. Basically designed for the typical employer plan who has multiple, you might have a trustee, but it has multiple participants. The solo K is kind of an odd one where it has all of the panoply of rules that apply to a fiduciary of a multi-participant plan with only one participant. And so one of the things that it doesn't have to do is it doesn't have to comply with all of those coverage rules and all of those comparability rules so that the highly paid employees don't get a better benefit than the rest of the employees. There's a bunch of rules and regulations about all that. But solo Ks don't have to comply with any of that because they only have one participant. And that participant is typically the owner of the business. They can be either a sole proprietorship, and there are a lot of real estate agents, by the way, who I know that have solo Ks because they're in business for themselves, and it has a lot of benefits for them.
Yeah, and I never knew they existed.
Okay. So you can have it for either a sole proprietorship or any kind of entity, whether it's a corporation, S Corp, C Corp, S Corp, LLC, whatever it may be. You can adopt a solo K plan. Your spouse can also be an employee and participant, but you can't have anybody else be a participant. So if you had employees that were working for you 10 hours a week, and the qualifying requirement is that they work 20 hours a week, and that's possible under ERISA, then you're probably okay. But most people don't have any other employees besides themselves and, in some cases, their spouse. All right. So the plan sponsor is the sole proprietor, the person, in our example, the real estate agent, and the real estate agent is their own is the participant, and they're also the trustee of their plan. Sound familiar? You're the only beneficiary, and you're the one who's in control of it, but it's an ERISA plan, not an IRA. So what happens is the Pensco offers solo Ks, and you go through a lot more paperwork, and I'll explain why, to establish it, and then you can start making contributions. The plan is typically a trust, and so the owner is, in addition to being the owner of their business, a trustee of the plan. So the business owner is the trustee of the plan. So there are two types of contributions in a solo K. One is the employer contributions, and those are called non-elective contributions. In other words, the employee doesn't elect to have them. The employer has to give them. That's part of the arrangement. There's no fixed amount for those non-elective contributions. They're basically what the employer determines is appropriate based on what their profits are. And they're deductible by the employer. In other words, the sole proprietor or the business owner can deduct the contributions to the plan. And then there are employee elective contributions, and those can be either traditional IRA contributions or Roth IRA contributions. Also, you can roll over a traditional IRA, not a Roth, but a traditional IRA, to a solo K, just like you could roll it over to a 401K plan at an employer. So let's talk about the comparison between these two different types of arrangements. So contribution limits. Everybody is pretty familiar with the contribution limits for an IRA or a Roth. If you're under 50, it's $5,500 a year, and if you're over 50 or over, you can contribute $6,500, and that's combined for Roths and IRAs. In a solo K, you can elect to defer up to $18,000. So you can either make it a Roth IRA, Roth deferral, or you can make it a traditional IRA deferral, but you can tell your employer, please deduct X dollars from my paycheck and contribute it, put it into my account, my separate account, as an employee elective deferral. And if it's the Roth deferral, then I understand I'm going to get taxed on it. And if it's not a Roth deferral, it's deductible up to the $6,500 range. But you can actually contribute up to $18,000. All right. So and the deferrals retain the character of whether they're an IRA or a Roth. All right. So the employer contributions, on the other hand, the employer can contribute up to 25% of the compensation of the employee, and that's employment compensation, not passive investment income and things like that. It has to be employment-related compensation, and the cap to that is $53,000. So let's say, I'll give you an example. Let's say we have an IRA owner who's under 50, and he can make a contribution to his IRA of $5,500 this year. On the other hand, if he's a solo K owner and he's under 50 and he has a salary, gives himself a salary of $100,000 a year, he has up to $18,000 of elective deferrals that he can make, and he can deduct $25,000. He can also contribute $25,000 to the 401k plan for a total of $43,000. And that's why solo K plans, one of the reasons why solo K plans can be very attractive.
Wow.
All right, so just so you know, Pensco has those available, and it really does allow you to defer a lot of money tax deductible. Okay, so we have the contribution limits. Now let's talk about taxation. Everybody knows about unrelated business taxable income, UBTI, correct? And you know that if you get unrelated business taxable income in your IRA or Roth, then you're going to pay tax on it. And unrelated business taxable income might be if you were selling widgets and you got income from that. That's not one of the exempt forms of income, exempt from the unrelated business income tax. So you'd have to file a return and pay the income tax from your retirement account for that. Same is true for solo Ks. However, more importantly, unrelated debt financed income, which IRA and Roth owners have to pay if they're, in other words, if you borrow money to buy a piece of property with your IRA or your single member LLC, or even if it's a multi-member LLC, the IRA's portion of the income that relates to the debt is taxable. So, if you borrow 50% of the purchase price, then 50% of the net income is going to be taxable income to the retirement account. However, solo Ks don't have the problem with unrelated debt financed income. It's actually exempt from the unrelated debt finance income provisions under the code. So with a solo K, you can actually borrow money to purchase a piece of property and you won't pay unrelated debt finance income tax. So another major difference is what happens when you have a prohibited transaction. So if you have an IRA or a Roth and many of the other kinds, if you can commit a prohibited transaction, the IRA is disqualified, and it's disqualified as of the as of January 1st of the year in which the prohibited transaction occurred. And the biggest problem with that is that if you do something and you're unaware that it is a prohibited transaction, and subsequently IRS finds out, let's say 3 or 4 years down the road in an audit, you end up paying tax for you have to go back to the year of the disqualification, you pay tax for that year. Since you didn't report it, there's underreporting penalties. Since you haven't reported it and paid it until now, you have interest and penalties for underpayment. It can get quite expensive. I think in the materials that I originally sent around to everybody, there's an example of what happens when somebody actually does that and it's discovered later on by their creditors or by IRS. They have all kinds of problems. So, that's the fundamental thing that most people who have IRAs and Roths are mainly concerned about. A solo K, however, doesn't get disqualified. It pays the excise tax under Section 4975. So let me give you a couple of examples. So Sam has a checkbook LLC, and he has a $100,000 IRA, and he invests $10,000 into his checkbook LLC. Sam then loans himself $1,000 from the LLC money to fix a toilet in a rental building he owns personally. I know that's a lot of money to fix a toilet, but he had to replace the whole thing. He then pays the money. Then pays the money back 2 months later. Now that is a prohibited transaction, clearly a prohibited transaction. You can't loan money from your IRA, and if it's a single member IRA, then it's just the same as if it's your IRA, to yourself. So the entire IRA, not just the $10,000, is disqualified. All right, even the part that's not in the LLC, and that's what I was talking about a little bit earlier when I answered that question about whether you should do investments in multiple investments in your single member LLC. And by the way, just to get back to that question, the main defense against third-party liabilities is insurance. Okay, so if you're investing in real estate, you should definitely buy liability insurance, and that'll take care of most problems. But in any event, so Sam incurs $100,000 of ordinary income for the year. Okay, that's considered to be ordinary income as of January 1st in the year in which he did this, just $1,000. So Sam, let's assume that Sam's in the 28% bracket. He now incurs an extra $28,000 in income taxes. Okay, and that's fairly intuitive. Everybody understands my IRA is disqualified. That means the whole thing is taxable. So the excise tax under Section 4975 is 15% of the amount involved. So you have to know what the amount involved is. The amount involved is not, in Sam's case, the $1,000. Okay, so the definition I have here is right from the regulations. It means the greater of the amount of money and the fair market value of the other property given, or the amount of the money and the fair market value of the other property received. And where the use of money or other property is involved, the amount involved shall be the greater of the amount paid for such use, or the fair market value of such use, or the period for which the money or other property is used. And then they give an example. Okay. So in Sam's case, what he's really done is he has used $1,000 for 2 months. Okay, so the amount involved in his violation is the fair market value of the use of that money, which in most people's parlance translates to interest on the loan. So in the Solo K example, Sam has his checkbook LLC, invests $10,000. He uses the $1,000 to fix the toilet. He pays it back 2 months later, and his Solo K is now subject to the excise tax under Section 4975, as is Sam. So he has to pay 15% of the amount involved? Well, the amount involved is the value of the use of $1,000. So what's the fair market value of the use of $1,000 for 2 months? Well, actually, the Labor Department and IRS publishes rates for the use of money in violation of ERISA. And let's assume that that rate is 3%. That's actually the current rate. So the amount involved is $1,000 times 3%, or $30. Okay? And the excise tax on that is 15% of $30 for 2 months, or 75 cents.
A little bit different.
Yes, it's very different. And the reason why it's different is that in the typical situation, you're talking about a plan that has multiple employees, and the person who's committed the violation is the trustee. Why? And it's the obligation of the trustee to pay this tax. Why should we penalize all of the participants because the trustee violated the law? So the participants don't end up being penalized at all, okay? The trustee's job is to bring the plan back to whole. So they have to pay the money back, and then they have to pay, and it can get very complicated. This is really a very simple example. It can get very complicated based on whatever it is that's going on. You know, for example, let's say that you've got a 401k plan and employees' contributions are being withdrawn from their payroll, and so in one payroll is 100,000. This is an example I was reading today. There's a $100,000 payroll. You withdraw from the payroll and you fail to pay it by December 8th of 2004. This is the example. And you forget to pay it until December 30th of 2005. Well, you owe the use of the money, and you have to restore the money, of course, the $100,000, but you also owe the lost profits that would have been gotten if the money had been there. Okay, so you pay both for the use of the money, and you have to restore the lost profits. So there's a fairly complicated, complex tabulation or calculation that goes on. And the Labor Department actually has a calculator on its website because they want people to voluntarily fix their problems. So, but that's not actually the tax. That's just saying this is what you have to restore. But the tax is 15% of the $30 for 2 months, or 75 cents. Okay? So that is a very key difference between a traditional IRA and a solo K. And I should tell you also that you can establish a solo K and roll your current IRA into it from whatever custodian you have, and then invest it self-directed. So just so you understand how that works. So the flip side of these advantages, of course, is the issue of complexity. IRAs and Roths are pretty simple to administer. Pensco takes care of most of it. You have to report value, and you sign a form. The solo K is relatively more complex. So here's the comparison of the various complexities that are involved. For unrelated business taxable income, both of them file Form 990T. Okay, that's an IRS form that's used to report unrelated business taxable income. Unrelated debt finance income tax reporting goes on a Form 990T for the IRA, but the solo K doesn't have to do that. It doesn't have to report unrelated debt finance income. Annual valuations. Typically, as we talked about earlier on this call, you'd really only value your IRA for distribution years. In the solo K, you're supposed to, and not everybody does this because as a practical matter you don't need to, but you're supposed to get a full valuation of the assets of the plan every year. And the way that happens is that, you're not, it's the third-party administrator that's supposed to take care of that. So every 401k plan has a third-party administrator. Their job is to make sure that the trustees are reporting everything correctly and that the assets of the plan are reported to the appropriate authorities at the Department of Labor and IRS. So every 401k plan has a third-party administrator. Of course, IRAs don't. So your solo K will end up having a third-party administrator. And of course, that means that you're paying third-party administrator fees, right? Which an IRA, of course, doesn't have. Then the main annual reporting that the solo K has to do is called the Form 5500. And that has to be filed every year. It's supposed to be filed by July 31st, but if you haven't, you can get an extension to September 15th if your tax return hasn't been filed. So you have to file a Form 5500 if the value of your solo K plan is over $250,000. If it's under that, you don't have to worry about it. Penalties for late filing can be fairly extensive. It's like $50 a day. And if you find that you're filing late, then it starts to pile up really fast. It's $50 per day per participant, I think. So it can get very expensive if you file late. So when you're supposed to make contributions, everybody knows you can make contributions by April 15th of the year following the year that the contribution is for. All right, so up until April 15th of this year, you can make your IRA contribution for last year. For a solo K and any 401k, it's really quite different. The solo K's contribution, the employer contribution, is generally going to be calculated on the basis of the employer's determination of how much they want to contribute based on their profits. So the employers doesn't really know what kind of profits they have until they prepare and file their income tax returns. So the solo K contribution has to be done by, and it turns out to be September 15th if you haven't done it by July 31st of the year following the year for which it's being contributed. All right, so the advantage of an IRA here is that you can put the IRA in now and it starts to accumulate. Whereas with a solo K, unless you get your tax returns done fairly quickly, you don't necessarily know how much you want to contribute, and that's deductible for last year. So, and you have to contribute it before you take the deduction. So you have to do your income tax calculations to figure out, okay, how much am I going to deduct? And then you tell the accountant, okay, here's what my deduction should be. So it's a little bit more complicated in terms of figuring out how much gets contributed, and that's basically a decision that you make about how much you want to put away up to your salary. So the annual calculation can be fairly complicated. And then it does take quite a bit more to adopt a solo K plan. For the IRA or Roth, the actual agreement that you signed with Pensco is an IRS Form 5305. There are several different 5305s. There's one for an IRA, there's one for a Roth, there's one for a trusteed IRA, one for a trusteed Roth. It's a fairly simple form. It says all of the things that an IRA is supposed to say, and it's prescribed by IRS. Pensco has basically adopted that for its own use and added on all of the things that it wants to add to the agreement, but it's a form. The solo K plan, however, is a plan that gets adopted by the employer. It's also a trust because the trustee of the trust holds the assets. And so there's an adoption process. If you're a corporation, you have to go through board of directors meetings and consents and adopt the plan and approve the trust and file those with your third-party administrator. And the pension law gets amended quite often. And amendments often mean that the plan has to be amended. So your plan, if you have a prototype plan, which you'd have if you had Pensco's, the owner of the prototype typically will send you notices saying, oh, you have to amend your plan to provide for these changes. And if you don't amend the plan, there's a certain time period within which to amend the plan. And if you don't amend the plan is disqualified. So it's important to keep track of that stuff. And so, the adoption and all that kind of stuff is quite a bit more complicated. And it's important for the solo K than it is for the Roth IRA or Roth IRA. And which is one of the reasons why anytime any employer adopts a 401k plan, they're going to adopt a prototype that's offered by an insurance company or a bank or whoever it might be. In Pensco's case, it's Pensco's prototype plan. You never want to completely write your own plan because that's very expensive. So these organizations, they establish prototype plans, they get them approved by IRS, and then they sell them. So, and that's their way of gathering assets under management. So, typically you'd use a prototype plan, and then you don't really have to worry too much about the adoption process or the amendment process because you're going to find out about it from the person that's providing the plan to you. So I think that's about all of it. Any questions?
I do. So I'm a sole proprietor.
Mm-hmm.
If I wanted to put aside much more money than I'm putting aside now, which is $6,500 a month for me and for my wife,
mm-hmm.
I could actually open up a solo K IRA, put away 25% plus the $18,000.
Mm-hmm.
I can then do a self-directed solo K.
Yes.
And buy real estate with that. So it allows me to gather more money more quickly.
Yes.
Wow.
I have one client who had a $1 million IRA with a custodian, and actually, I'm sorry, he had it in a solo K with a custodian, and he decided that he wanted to invest it with a broker in Switzerland. It's an American licensed broker, but they have access to different securities there. And so the only way that he could end up doing that was to adopt a self-directed IRA, self-directed solo K, and direct the solo K trustee, meaning himself, to invest his account in a single member LLC that then invested the money with the foreign broker. It's all in publicly traded securities, but that was the only way that he could avail himself of the overseas investment, because the broker dealer that he had with his former custodian couldn't offer the securities that were issued overseas. So, it's a very flexible and very interesting strategy for people to use if they're in business for themselves and they want to self-direct. And oh, by the way, you don't have to put it all in self-directed. Excuse me, you can invest it with publicly traded securities as well. So, any questions? Go ahead.
No. This a lot of this stuff is so much to absorb. But I have to come back and revisit this. Probably too late for me to do it this year, but going next year, it seems like I should be looking at this.
Yes. No, you have to have adopted the plan by December 31st of last year. Okay.
Okay.
but you can adopt it anytime this year and make contributions for this year, next year.
Right. Got it.
All right, any
All
other
right.
questions?
No, I'm good.
I'm good, Joe.
All right, well, thank you very much. It's been a pleasure. And I think that this one's going to be posted on the website for access by the members. And have a good evening.
All right.
You
Thank you
too,
very much.
Frank. Thank you.
All right.
Bye.